or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger. They could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just, you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is, the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increase to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is, there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah. So there'll be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening, not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things. And you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that. And we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks. And we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Labor non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services. But we're not seeing progress there. So we do, what we expect for next year is continued, what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
Edward.
Thanks, Chair Powell. Edward Lawrence with Fox Business. So in December, we saw employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation, CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable. And, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can, we're at 3.0% core. Inflation 2.8% headline. So we've been well above the 2%, that amount, whatever it is, 0.7, 0.8, or a full percentage point above 2% for some time. And that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today?
So you're not going to get much based off of what Powell's talking about. I put it in Powell saying we're on hold. Inflation still matters. Oil complicates everything, and nobody should assume easy cuts are coming soon. So I got off of it because the market is just gonna it's gonna be mixed signals. It's gonna put pressure on the rally, seller rips and stuff like that. Tougher environment now, and the oil price stay elevated. So same thing that we already know. But markets could price this in faster though. So right now, he seems like calm. He's always calm on the outside, but he's restricted. But he's being restrictive though. So it's like it's mixed signals. Yeah, it's definitely mixed signals. So the market is not really reacting too much. It's hawkish and dovish at the same time, to be honest. So it wasn't good, and it wasn't really too bad. So we'll continue to trend. So right now it's basically just the macro data from earlier, because FOMC was kind of mixed. He's still talking, so we'll see well, I'm probably going to end it though. I just wanted to see overall what he was talking about. We'll probably still stay in this selling channel though, and just continue lower because we broke this trend line right here. Yeah, that's nasty. So overall, I'm looking at 6,700. We break under there, then we're gonna get a little flush. Um, so not hawkish, not dovish. VIX, I don't think VIX even moved. It actually dropped lower, so probably bounce up a little bit, then sell off. So yeah, there's not really too much. Um, bonds is exploding still. So we'll just keep our eye on the 10-year, the 10-year yield, the 2-year yield, VIX, oil, and then since we're to the downside, we want to watch Nasdaq because Nasdaq is very fragile. It's heavy because of tech, so it's really sensitive. So if we're really falling apart, Nasdaq will make the move first. So you can see on the daily, it's nasty. It just lost its 10-day, so we could end the day flushing. Um, that's Nasdaq futures, and the index. It's a lot. Yeah, you don't even see buyers stepping in nowhere. So we'll probably go down to the 200. So it probably be a controlled sell off to end the day. So we watch bonds, watch the VIX, watch your NQ, your ES, and then your NDX and your SPX, and watch the dollar. Yep. See, look, remember when we looked at it, the dollar had rejected and was down here. Now look, the dollar's ripping up. So all this points to risk off. And look, Bitcoin is crashing. It lost the 10-day just now. We didn't close yet. Risk off environment for sure. Everything is selling off. Everything. Because your SPY, yeah, everything's selling off, but the bonds is ripping, dollar is ripping. That's not good. And then what's the one? What is it called? I can't get it. I can't remember the name. There's one that I pay attention to that tells you inflation if it's going up or going down, but I forgot the ticker of it. So we looked at Bitcoin, we looked at that, SPX, all that. Pay attention to your oils, of course. WTI is not doing nothing still. But really we want to pay attention to Brent crude futures. 108 basically. It got to 110. So yeah, we're paying attention to this. It's going to try to get back up here to that 118 level. If it holds 120, that is crazy. But I just wanted to update y'all real quick as far as that. Bitcoin going to continue to go lower. SPX going to continue to go lower. I got one thing. The market is sitting in negative gamma with clear imbalance. Dealers are short gamma, 17 billion. Put positioning is dominating. The market is unstable. Moves will accelerate, not mean revert. So we're pinned between that 67, that 6,700. We're pinned between 6,700, that level that I wanted us to break, and 6,753 to 6,700. Call gamma cluster. Break the buying fast. If we break this right here, we'll snatch this liquidity and have a squeeze. We have a major put wall at 6,600. So, and if you have a put wall, it's the same as a call wall. If you break a call wall, you snatch all of those contracts If you break a call wall, you'll get a gamma squeeze. If you break a put wall to the downside, same thing happens, but you squeeze but you flush though. So it's not a trend environment at all. It's trigger based environment. Price is compressed right now, but it's going to expand very, very soon, and we can get fast downside acceleration. So if we break, basically, we break 6,700, we will get a squeeze. You will see it run to 6,725, and then it'll run to 6,750 fast. And if we reject and lose 6,000, what was the level? The AVWAP, oh shit. If we lose this 6,650 close on like the hour, I would say, if we close below the 6,650, we're going to flush and we're going to accelerate down to 6,620 and then the put wall at 6,600. And if we lose that 6,600, it's not good at all. That's all I got for y'all. I just wanted to update y'all. And yeah. So everybody have a blessed day. Let me make sure it's not just talking to myself. Okay, good. Everybody have a yeah, I wasn't sharing nothing just now, but I was sharing, but I took it off. But this was, if you want to see, I was oh damn, where'd it go? So my AV WAP is this purple line. So this 6,650 is what I want to. Well, if you're in college, you want to hold that, but we just broke below that, so that's not good. So yeah, you could just play this over. And those levels, it matters. 6,600 is the put wall. That's really what you want to pay attention to. We're 43 ticks away from there. So it's that level really matters. And then to the upside, we said 6,000. Damn, I forgot what I said. I believe it's like 6,760 area. We really want to break that 6,760 area though, and then you'll get the squeeze. So if that's what you really want to pay attention to. Was it that I got 6,000? What was it? 6,000? Yeah, 6,760. I said 6,650 because that's the 10-day right here. But well, this 10 days at 6,730, but we got the AV WAP at 6,760. So for calls, you want to see us break 6,760 for a squeeze to the upside. For puts, you want to see it break 6,650, which is doing. And if we break 6,600, it's going to flush down ace. And if you stay between those ranges, you're not going to do nothing. That's all I got for y'all. Have a blessed one. Get money.